So welcome into the most popular video series that I do on the channel, which are the stocks that I have been buying recently. And this is just a video series where it just keeps up the transparency so you guys know what stocks I've been buying and you could track and follow those stocks and keep up with what I'm actually doing in the market. And also I like to keep up this transparency, especially when so many YouTubers have fallen off the scene in this bear market. I'm still here telling you what I'm buying, what I'm selling as well. And apologies, there's been no videos for a week. I did decide to take a break off YouTube for a week. I went on holiday, and if you've been following my personal Instagram, you would have seen the trip that I had to Paris last week. And I think that's actually the first time I've had a week off making YouTube videos since either 2018 or 2019. I think, yeah, over 3 years since I last took a break from filming some YouTube videos. So definitely overdue and well deserved, but we're back here making some videos, so let's get started. And as always, if you don't want to wait for the monthly update, you can get my live buy and sell alerts through the Patreon, and I also post 2 exclusive videos a week. I dropped my first video back yesterday, which was a US portfolio review, and I also talked about 2 stocks that I have sold recently as well for some nice profit and why I sold them. So if you do want to join that, it is only £5 a month. I think it's definitely worth it for the time and effort that I do try put in. And as well as that, if you do want some free shares, it is the new ISA season. So if you do want to start using a new ISA on Trading 2 and 2, join through the link in the description. I've seen that be very popular over the last few days. I saw someone also picked up a free share of PayPal worth, I think it was like £80, and someone got a free share of Disney worth £40 as well. So do go check that out, but let's get started. So first one on the list, I made a video on this, was Celsius. I sold out of my Celsius position, and I thought I'd just stick that on the video just in case anyone missed it. I did exit my Celsius position. I've been selling out this position for probably, I would say, nearly a year now. At some points I was taking nearly 100% return from this stock, and then finally I closed my position out at 45% profit, which is really good amounts of profit made from this position. And in case you didn't see the video on why I sold Celsius, which is a more detailed video, just to keep it nice and brief, the reason why is I just thought the valuation got really stretched on the business and it was trading at a premium. And when I was looking at the financials, I felt like there was a risk that potentially they can't carry on at this valuation and deliver the financials they need to command the valuation. And an example of that was the revenue. For example, if you look from the recent quarter, Q3 to Q4, the revenue was actually down quarter over quarter. Now, they did do this in 2020, so it's not the first time they've had negative growth quarter to quarter, but they didn't do it last year. And when you think about the partnerships that they've announced, and I also had worries about the international expansion and the competition of Prime coming in this space, I just thought for the valuation and the little things that I was seeing inside the company and I'm not happy with, I thought I'm going to take my profit here. So that was a big cash generator for me in the month of March that then allowed me to go buy quite a few stocks after this. So that was a really big cash generator that let me go buy quite a few companies, and there's going to be quite a few companies on this list. It's quite a long video, so we'll get started on the first stock. So the first stock was Walt Disney. Now, actually at the start of March, before we ran into April, as you can see here, the stock was actually back at $90. Now for me, I like Disney under $100. When it gets to $90, that's normally where I end up pulling the trigger every so often if I can, because I want to build Walt Disney up into a top 3 position if I can, and I've got a really nice chunky position now with Disney. I saw it enter back into that low $90 range, so I did pick some more shares at this point here. And when we look at Walt Disney, it's one of the greatest brands, if not the greatest brand out there. You've got the parks, everyone knows the parks. It's the generation of a lot of the profit. Expanding into the entertainment business, obviously they've got the movies, they've got the Disney Plus, and the brands they own, like the Star Wars brand, for example, and all the other brands they own, they can just throw off good amounts of content on whatever they want to do. So something like a Star Wars, for example, they've just announced another 3 films from the Star Wars franchise, and once again these films will go absolutely ballistic at the cinema. Now there is, and for me personally, I have been a little bit unhappy with some of the content that Disney has brought out and hasn't been as good recently, but they're still going to put bum on seats to watch this content, and they can keep bringing out content with the amazing brands that they currently have through the Pixar films, through the Marvel films, through the Star Wars films. One of the greatest brands out there. And they also made a dramatic change in the back end of 2022. Bob Iger is back at Disney, and this is after Bob Chapek had got the push. Now, I actually thought he wasn't doing too bad of a job, but he was not making shareholders happy. And what Disney did is they brought Bob Iger back because he does make shareholders very happy. And that was already clear on the recent earnings that he did. He's done his first earnings back as the CEO, and as well as delivering okay financials, he basically did everything that Wall Street wanted to hear. He said he's going to be cutting jobs. That's what Wall Street want to hear at the moment. And he also said he's going to bring back a dividend in 2023. Now, personally for me, I don't know if this was the right idea to bring the dividend back, but what does a lot of the shareholder base previously been in the stock for is a dividend. So they are going to hopefully drive profit forward, revenue forward, and also bring back the dividend. Now, one of the ways they're going to generate a lot more profit is they've been maximizing the parks, because that's the biggest part of the profit generator for Disney. But the Disney Plus, that's been the growth driver, but they are going to try drive the Disney Plus platform to profit in 2024. And that is one of the big aims for Disney. So Disney should have a lot more growth going forward, driven by the parks, by the Disney Plus, and the focus of driving now forward the profitability should mean we see big amounts of profit start to be restored to Disney like how it had previously. Now, it probably won't get to these levels for a little bit, but as the Disney Plus numbers start ramping up more and more, and these efficiencies start kicking in, we could see that really start to be driven forward, and Disney growing at faster rates previously than they have ever done before. And I think when you consider the brands that you're picking up with this stock, it is one of the biggest moats, I think, out there for sure. So yeah, bought some Disney. I think under $100 is good, especially when it gets that $90 range. I'm a big fan of Disney. Next one is PayPal. So right now, PayPal at $74. I'm a big fan of PayPal. It's 35 times earnings at the moment and an 84 billion market cap. Now the share price is actually at levels that it was at previously in 2018. So this basically has had 5 years of share price appreciation wiped out, which shows you how much pain the stock has been through at the moment. But I think this has now created a really good buying opportunity in the stock. Now, PayPal itself has done very well to keep maximizing the product. People like to use PayPal as a safe, easy option to use rather than actually using credit card details, debit card details. You can shop through PayPal, which is a recognized brand which you feel is safe to pay through. Also through other products as well, and business products, and also buy now, pay later. It also operates or owns the platform Venmo. Venmo is a very popular peer-to-peer app, and you can see here the revenue that has been growing massively through Venmo, even though once again, this has had some tough comps, as you can see, through 21 to 2022. It has grown rapidly over the last few years. Now, PayPal actually put in my opinion, very good Q4 earnings. The Q4 earnings were fantastic, and the guidance was very strong as well. You can see here the adjusted EPS was to be $4.87. This was above the consensus estimate of $4.76 that was expected by analysts, and it also sees revenue growth of 7.5%. Now, I think further down the line we'll actually see PayPal get back to close to double-digit percent revenue growth as well. Now, even though the company reported good earnings and offered good outlook, the stock has been a little bit flat recently. I think this is because potentially we could see a CEO change coming in the next 12 months, and maybe that is holding the shares back a little bit at the moment, but still financially I think the stock is performing amazing, especially when you look at the valuation. And if you actually look at the long-term growth here, you can see that analysts actually for this year are expecting 6% revenue growth and expecting 9% in 2024. And I think when you run close to 9-10% revenue growth on this company, and if they can carry on driving profit forward, this is going to be a good valuation. And you can see here the profit that has dropped off recently inside the business, but as they carry on now driving the profit forward and the revenue forward, you can see here we could be moving up to 3.7 billion profit, up to 4.4 billion profit, and by 2025 5 billion profit, or 8 billion in free cash flow, which I think puts it at a very attractive valuation. Top that off with a pretty solid balance sheet as well, and when you consider the tough comps that it has been through recently, where the company in the last few years has gone from 17 billion in revenue up to 27 billion in revenue, you can see here that the company has had a bit of an explosion, is just playing catch up to the demand that has been pulled forward. Look at the metrics it's trading at. It's trading at very cheap metrics compared to what it historically did. If we use pre-pandemic metrics, you can see here total enterprise value to revenues was a 6 before the pandemic in 2019. It's now a 2.9. If you look at total enterprise value to EBITDA, 24, it's now 11. That's over half once again. And if you look at the market cap free cash flow, it was 31 times in 2019 and 13 times currently at the moment using a forward multiple. So I think these metrics are very cheap for a company like PayPal, a very recognized brand, good growth still going forward, and they should now continue to drive profit going forward as well. So I'm a big fan of this one. At the moment, PayPal is a company that I'm trying to build into a top 3 position. If I can, I could actually make this a number 1 holding. We'll see what happens. Which actually ties on very nicely to Google. So I was trying to make Walt Disney, PayPal and Google my top 3 positions. Walt Disney could still happen. PayPal could still happen. Google is a bit 50-50 because this has had a very big ramp up on the share price recently. So I am hoping now that it does pull back a little bit. But before the share price went a little bit crazy at the moment, you can see here that in the last few weeks, we've had the run up to nearly $110 again. At the start of March, this stock was actually in the $90 range, which is where I was really wanting to buy. And I was buying this nearly every single week, as most of you guys on the Patreon would know. And in my opinion, to probably get what I would say is the best company in the world and the best balance sheet in the world at $91, and that was roughly, I think, 18 times earnings, was an absolute bargain. And I was buying shares massively. I wanted to make this my biggest position by far. The brands and the market share that Google own is unbelievable. You look at the brands, Google, the cloud, Maps, Android, YouTube, all the other little bets that they have going on. This is a major company that will have a very good future going forward. And this big drop in share price was caused by the AI situation, which has been massively overblown. People are writing off Google because they think that ChatGPT is going to be the killer of Google and think that Google aren't going to respond to it. It's one of the most ridiculous dips I've seen, and I was trying to buy shares massively in this, and Google will respond to any threats that they have had, which they've done previously in the last 10 years. Now at the moment, the earnings for Google haven't been as good as some other companies that will be mentioned on this list, but I think they will resolve the issues they have. So you look here, the EPS was a miss. The revenue was only 1% growth year over year. They missed that. And you can see there's quite a lot of weakness in their main businesses, which is like Google search and YouTube ads. Now, the reason why is because obviously they're advertising, and what we've seen advertising at the moment isn't going to do well in the recession environment that we have. The big question is, do you think this is going to last forever? I don't think this is going to last forever, and I think advertising will rebound. We'll see Google search rebound. We'll see YouTube ad rebounds. I think this is just a patient waiting game with Google, and Google should go back to 10+% revenue growth going forward. And you'll be able to see that analysts are expecting a stronger recovery in the back end of this year, and by 2024. This situation to be resolved, and they go back to very good growth. And I think when you consider the growth that Google have and the valuation it's at, I think it's a very good valuation for sure. The good thing is that the other part of the business that's coming up is Google Cloud. Google Cloud has been the strong performer, whereas the YouTube platform has been weak, the Google platform has been weak. Google Cloud has been impressively growing. And the thing is that Google Cloud does not make profit at the moment, but if we expect Google Cloud to grow at these rates continuing, and they put in the profits, say Amazon Web Services does do, then we are going to have a serious company here with good amounts of growth and profit being driven forward through YouTube ads, YouTube network, and then potentially the Google network, and then we have the cloud coming in and 3 big income drivers going forward as well. And like I said, I think you have one of the best balance sheets in the world here. They sit on 5% debt to equity, but on the cash balance, 113 billion in cash, and every year they're making around about 50-60 billion in profit as well going forward, and that just keeps going to the bottom line, and they could use that for buying back shares. Once again, this is an unbelievable profit driver and an amazing balance sheet as well. Big fan of this one. And the next one is Block. So Block has been having a tough time through the last few weeks. First of all, it came off earnings which I thought were very good. They did miss slightly on the EPS. Revenue grew 14% year over year. Without the Bitcoin revenue, it was actually 33% year over year, which was really good. And they have a few parts to the business. They basically have the transaction-based revenue, which is the likes of Cash App. Cash App is a very popular peer-to-peer, basically between Venmo and Cash App, the biggest peer-to-peer platforms in the US, and that's doing okay. The big part why I'm in it is subscription and service-based costs. So this is or revenue. This is basically platforms that Square offer that is like managing payroll, inventory, invoicing, and this is the part that I really like, and it's the fastest growing part. You can see here in the recent earnings that grew 68% year over year. Hardware revenue, which is basically the payment platform that you might have seen, where if you go to a shop, they have the card machine, you pay on the card machine, which is basically growing at quite slow rates. And the Bitcoin revenue, which is not really a big important part to the business. The problem is that it's dragging the revenue down a little bit because it, as you probably know, Bitcoin went a little bit crazy in 2021. So the main reason why I got Square is because of the subscription and service-based revenue. Now, as well as that, it's the fastest growing part at 68%. But as well as that, it's the most profitable part. You can see here that the actual cost of revenue is actually on 861,000. So you can see here that they're making very good amounts of profit off this part of the business, and I think this will continue to do very well. And that will be the key revenue driver and also the key profit driver going forward for the business. Now, you might have seen that there was a short report out for Square that or Block. This came from Hindenburg. Now, actually, when you look into the actual Hindenburg report, I was a little bit worried when I saw this, and when you actually dig in, I was like, this is actually pretty poor from Hindenburg. They basically only claim, or the only claim that was serious is towards the Cash App part of the platform, saying that they were allowing a lot of illegal services and transactions to be used on that platform, and it's very easy to set an account up or potentially use someone else's name to potentially set up an account. It was very poor. I was expecting something like fake revenue, fake profit, or the money that they're creating. So nothing that really deserved the drop that it currently has, and that's probably why we're seeing the share price starting to recover a little bit since that dip. So I was still happy to hold from that situation here, and I think it's going to be one of the continuing big upcoming payment platforms in the future. And that leads on to the next stock, which is InMode. So I did buy some more InMode. This is a stock that I've held since around about June 2020. So when the stock was around about $16, $15 is when I first buying it. I have averaged up through that time frame, and once again, it was another average up for me. I just keep buying it because even though I'm up on this position, I still look at this company and I think at 2.7 billion market cap, at 17 times earnings, it's, as far as I can see, one of the best stocks on the stock market at the valuation it's at. This is a company that does non-invasive surgery. So basically, let's say you have an area of skin that you're not happy with. Maybe the skin is a little bit fatter than what you want it to be. Then what InMode can do is they can use some of the technology like heating up that fat part of the skin to burn that fat, and it reduces the size of that, and obviously someone will be happy with it, having that done, and rather than having to go under the knife and being put to sleep, that obviously is method of having that done would be a lot more preferred by the patients, as well as other technologies as well. You can see here there's face, body, skin, and they're always bringing out new technologies as well. On the recent earnings were once again absolutely fantastic. You see here EPS was a beat by 0.09. Revenue grew 20% year over year. And when you look at this company and you're picking this up at 17 times earnings, just absolutely crazy. You can look here, like the growth has been absolutely insane, as you can see from the revenue and profit. If you have a look at the financial health, there's no debt on the balance sheet. They're currently sitting on 547 million of cash. Now, I know they're currently looking for an acquisition, but in the meantime, I would like InMode to start using that cash, just potentially throw out a 10 million buyback. It's nothing really to affect the balance sheet, and it just keeps shareholders a little bit happy. I would like them to start doing that a little bit if they could. That would be my only criticism of the business. But I mean, look at the metrics this is trading at for a company that's growing profit and revenue like this, and this balance sheet. You're picking it up at total enterprise value to EBITDA around about an 8. You're around about free cash flow over 12. Future normalized earnings over 12. It's absolutely crazy. So I mean, I averaged up, and I generally look at this one going again, like, I think this is one of the best stocks on the stock market. Why am I not buying any more of it? And I keep thinking about it. So we'll see what happens. I might have to buy even more going forward, because I just got to bite my pride a little bit, and I don't really want to be averaging up on a position. But if it's one of my best performing companies financially and it's still at a crazy valuation, it shouldn't stop me from buying more, and I should continue to buy. So we'll see what happens there. Next one is JD.com. So I bought JD.com for the first time in 5 years. That's correct. I think it's 5 years. It could be even 6 years. This is the first time I bought JD.com for like 5 or 6 years, which is absolutely crazy. So I have started buying some more JD.com. The reason why is I think this company is going to be set for a very good future now, with a lot of the situation in China starting to calm down and the valuation it's trading at. Obviously, you guys will know JD.com mostly from their e-commerce platform, selling products, their automated service, and also the logistics site that they currently have as well. Obviously, the China opening up is starting to happen, and you can see here that these financials were still pretty decent when you consider the valuation and continuing what they should do with the growth going forward. In my opinion, it looks an attractive valuation, and now revenue and profit should start getting driven up, as well as a very healthy cash balance. And also they are paying a dividend out to shareholders, which makes me think that if they're going to carry on growing the profit and have this amazing balance sheet, they might continue to reward some shareholders going forward as well, more than what they have done previously, which is really good. The next stock is Lovesac, so I'm going to keep this really nice and brief because in the month of March the stock did dip back down to the $21 range, and I did buy some more shares, and since then the stock has gone absolutely ballistic, and there might have been another change in the position, and that's why I'm going to keep it nice and brief, because I might have changed my portfolio, which most of you guys on the Patreon would have known about, and know what I've potentially done with that position. So I'm going to keep that nice and brief because things have changed with this position, and that's what we'll say on that one. The next one was Topgolf, and is the last one on this list, and Topgolf has had a bit of a weak time recently with the share price not doing much, but I think at the moment Topgolf is very well positioned to be a stock, in my opinion, that will double up in the next 5 years. I see this going to be a $40+ stock, even a $50+ stock in the next 5 years. Now the reason why is because they are obviously Callaway Golf, they've got the golfing brand, they've got the clothing brand like Jack Wolfskin, and that's going to be a stable revenue and profit generator for the business. But the big driver going forward is this, Topgolf. They're going to open up more Topgolf venues. Topgolf venues are great for parties, events, food, drinks, and also going with friends and playing at these venues here. And they seem to be very, very popular. And the only criticism that I've seen of Topgolf is that it's just so popular that the queues take ages for you to actually go play. And I think that the more these open up more and more Topgolf venues, that's what's going to be the key driver of profit and revenue once the payback of opening up the venues has passed a certain time and revenue carries on being driven forward by the new venues. This is going to do very well. It's a very simple business to get your head around, and the combination now of having the leisure wear, the golfing business, and then the Topgolf business, I think this makes it the ultimate golfing business as well. And you can see here that Bank of America agreed with me because they said that in 2023 there's going to be very big tailwinds going forward, and they said that as well. You can see here that the same venue sales grew 11%. That's obviously not including the new venues, and you can see here that they think that Topgolf is going to be valued to $32, which thinks is going to, or what is going to be 11 to 12 times the 2024 adjusted EBITDA estimate. So they can see that in the next year that they expect it to be $32. And like I said, I wouldn't disagree with that. I think in the long term we would talk about Topgolf being a $40 to $50 stock, and I think it's a very easy business to get your head around and is, I would say, quite a safe investment as well. So yeah, this is just a mid-sized position in my portfolio that I just kind of keep nibbling to because I do think they always keep executing on the business. So yeah, that's the last one on this list. So I won't keep you for any longer because I think this video is starting to push towards maybe around about half an hour long, and there's a lot of stocks there, so I did try to keep it nice and brief on a lot of them, but for a lot of them I do have more of a detailed kind of 10-20 minute video deep diving into the business a little bit more on the YouTube channel. But I know that you guys like it in the quick fire format when we do these sort of videos, so you can get through the stocks nice and quickly. So I hope you enjoy the video and enjoy the first video back. As always, if you could hit that like button, that really does help with the video and helps the YouTube algorithm. And apart from that, I'll catch you all in a bit.